Want to be sure you're getting the most out of your retirement for all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now here's Jim with this week's Dollars and Cents tip.
Today I want to talk about the budget crunch and what we're hearing coming out of Congress in Washington. Earlier this week on the Today Show, they were interviewing some politicians, and they said, can we raise tax revenue without raising taxes? Can we bring in more revenue to the government, which has to be tax revenue, that's the only way they bring in revenue, without raising taxes? And every one of them said, no, we can't do it. I beg to differ, because if you look historically, the answer is yes. That's not my opinion. That's a fact based on history. And I don't understand why we can't get those kind of straight answers from our politicians. Because if I go back to 1950 and I look at our tax revenue since 1950, if you look at tax revenue as a percentage of gross domestic product, which is our economic output as a country, the goods and services produced by the United States, sold here and all over the world, our total economic output, tax revenue has always been between 15 and 20% our GDP. And for most of those years, it's been around 17 to 18%. It's been very constant. There's not a lot of jumping around on the percentage of GDP. Yet our tax brackets, since World War II, our highest tax bracket is 94% in 1946. Most of the 50s, it was over 90%. It wasn't until 1986 it dropped down to 28%. It's been as low as 28. The highest tax bracket right now is 38. Through all those different tax brackets, from 94 to 28 and everything in between, it's been 15 to 20% of GDP has been our tax revenue. And most of the time, it's 17 to 18%. It doesn't really seem to matter what the taxes are. What matters is that we have economic growth. If we have more economic growth, it's like, what would you get? Would you rather get 15% of, I'll just use a number, would you rather get 15% of $100,000 or get 20% of $50,000? Well, I'd rather get 15% of $100,000. If you raise our economic output, you raise tax revenue. That's the bottom line. That's what our history suggests. That's what has happened historically. I don't understand why we can't get those kind of answers, but that's just politics, I guess. It's the short-sighted nature of politics, and it is frustrating, but that's the reality. Everything we should focus on, in my opinion, should be policy that creates economic growth or stimulates economic growth. We can't break the bank. We can't just make no tax, but there's a balance between what's the optimal, and this has been debated for years, what's the optimal amount of taxes to stimulate economic growth. But the bottom line is, historically, our history suggests we don't have to raise taxes to raise tax revenue. We need policy that stimulates economic growth. As we get more economic output, that will raise tax revenue. That, for this week, is the tip that I want to leave you.
And that's our Dollars and Cents segment for this week. You can find this week's Dollars and Cents segment and others by visiting BroganFinancial.com.